Good afternoon to everyone. This is Miss Kurt warmly welcoming you once again for today's webinar. I hope all of you are having a good day so far, and on behalf of our team, I would like to thank you for joining us right now. The corporate tax has been effective from yesterday, 1st of June, and last week we have already covered who will be subject or the taxable person under the corporate tax regime. Now, the next question is which income are going to be subject to corporate tax? So, for today's session, we'll be focusing on the taxable income and income that will be exempted from corporate tax. Moreover, we'll be giving a brief on the decision relating to qualifying income, which was released just yesterday. So together with me is Ms. Mariam and Mr. Muhammad Sharik, who will be joining us in addressing your queries in the question and answer session. And as usual, we'll be starting by discussing the relevant topic for this week. You may send your questions on the message box below, and we will have it addressed on the latter part of this session. So as the pointers for this week's webinar, first we'll be discussing about the taxable income, the definition and the determination and how you'll be able to derive the taxable income for the relevant tax period, the adjustments to be made, and the accounting method. Next is the small business relief to be followed by the exempt income, the conditions and how the income is going to be considered as exempt under the corporate tax. And lastly, we'll be giving a brief on the qualifying income, the categories, the taxable income of reasoned person, and the minimum requirement for it to be met. So what is taxable income? Taxable income for a tax period refers to the accounting net profit or loss after making adjustment to certain items specified in corporate tax law. In most cases, businesses in UAE are required under applicable federal or emirate level legislation to maintain proper records and financial statement that would reflect the financial status, such as the assets and liabilities or profit for the relevant period of the entity or business. So such records are to be prepared in accordance with the accounting standards that are accepted in the UAE. So in determining the taxable income for the purpose of corporate tax, the accounting net profit or loss as stated on the entity's financial statements will serve as the starting point. So the taxable income of each taxable person shall be determined separately on the basis of adequate standalone financial statements prepared for financial reporting purposes in accordance with the accounting standards accepted in the state. This ensures that each taxable person uses common accounting standards to determine their taxable income while providing flexibility. Further, having a standard on the preparation of accounts promotes more efficiency and reduces compliance costs and provides a base that follows the international standard. So, a person subject to corporate tax must compute their taxable income by reference to their tax period, which is usually the financial accounting period of the company. So, as I have mentioned a while back, the accounting net profit or loss will serve as the starting point to determine the taxable person's taxable income after certain adjustments are made. So as what you can see on the presentation, these are the days of adjustment that has to be made to be able to come with the final taxable income of the corporation. So unrealized accounting gains and losses reflect changes in the value of an asset or liability before it is sold or settled. So these gains and losses or unrealized gains and losses has to be adjusted to the starting point of the taxable income. So the next one is the exempt income, which one of the examples are the dividends, gains, income from participating interest, income earned through a qualifying foreign permanent establishment, and income from operation of ships in international transportation. This is followed by the reliefs that is available on corporate tax, so such as the reliefs in regard to intra-group transfers of assets and liabilities and other qualifying business restructuring transactions are present, which is intended to eliminate the obstacles from the corporate tax. So deductions also has to be adjusted on the taxable income. So these refer to like expenses that are incurred wholly and exclusively for the purpose of conducting the business of taxable person can be considered as deductible for corporate tax purposes. To ensure fair taxation and prevent tax-based erosion, certain limitations are placed to the deduction of business expenditures that could be applied. So adjustment for any transactions with related parties and connected persons. So for corporate tax purposes, transactions with related parties and connected persons are to be done on an arm's length basis, where both parties are to deal with each other as if they are engaging with an independent party. So to prevent the manipulation of the taxable income, the corporate tax law requires the consideration of transactions between persons and their common ownership or that otherwise related to be determined by reference to the market value, irrespective of the value reported in the financial statement of the taxable person. So these are followed by the adjustment from the tax loss relief. So this can either be done by deducting tax losses on the subsequent tax period or transfer of tax losses to another taxable person. So again, this is intended to reduce the taxable income of the taxable person by utilizing the tax losses incurred during a specific relevant tax period. So incentives or special relief for a qualifying business activity and income or expenditure that has not otherwise been taken into account in determining taxable income as may be specified in cabinet decision will also be included on the necessary adjustments. And lastly, any other adjustment that may be specified by the minister. So the minister may specify other adjustment or make regulations to address particular types of transaction whose accounting treatment may be vulnerable to manipulation of the termination of the taxable income. So on the determination of taxable income, it is possible that a taxable person may pursue an election to use realization basis in terms of gains and losses. Unrealized gains and losses may arise in cases where a change in the value of an asset or liability is recorded in the person's financial statement, but a transaction is yet to take place to realize the actual gains or losses. So such cases mostly happens where the accrual method is used as the basis for a taxable person's account. It is therefore possible that even with the absence of actual disposal or settlement of assets or liability, a profit could still arise from that transaction. So due to which no receipts could be used to pay any corporate tax liability that may arise as a result. So an example of this situation would be a change in the exchange rate of a foreign currency contract yet to be settled at the end of an accounting period. So, as a way to prevent this circumstance, taxable persons who prepare their financial statement on an accrual basis may elect to take into account the gains and losses on realization basis. So, this means that for the purpose of calculating their taxable income for a tax period, is determined when an asset is disposed of or a liability is already settled or a different realization event occurs. So it is important to know that the election must be made during the first tax period and is irrevocable, except under exceptional circumstances approved by the FTA. So an election to be taxed on realization basis must specify whether the election is being made either in respect of all assets and liabilities that are subject to fair value or impairment accounting under the applicable accounting standards, or only in respect of assets and liabilities held on capital account. So the assets and liabilities held on a capital account at the end of a tax period, whilst taking into account any unrealized gains or loss that arise in connection with the assets and liability held on the revenue account at the end of that period. So an example of assets held on capital account are non-current assets that a person does not trade, such as a property held for investment purposes or intangible assets developed by the person for use within its own business. So essentially, capital items are items that have long-term impact on a business. Liabilities held on capital account, on the other hand, are non-current liabilities which the business expects to hold over the long term, such as long-term loans or other debt obligations, and liabilities which do not give rise to deduction under a specific chapter on the corporate tax law. Now we're moving on with the small business relief. So this is specifically in reference to Ministerial Decision number 73 of 2023, which refers to the small business relief for the purpose of corporate tax law. So on availing or electing for a small business relief, there are certain conditions that a taxable person must meet. So small business relief seeks to support startups and other small or micro businesses by reducing their corporate tax burden and compliance costs. It was issued in accordance with Article 21 of Corporate Tax Law, wherein they have mentioned that a taxable person that is a resident person may elect to be treated as not having derived any taxable income for a tax period, even that the person has met the condition as prescribed in the decision that we will be discussing right now. So this small business relief allows taxable person to benefit from reduced compliance requirements, including the transfer price. So on this specific decision, they have mentioned about the revenue threshold, which is for the relevant period and previous tax period, the taxable person must not have a revenue exceeding 3 million dirhams for each tax period. So a taxable person should not be able to elect to apply the small business relief if their revenue in any relevant or previous tax period has exceeded this specific threshold. Now, the small business relief would be available for those who have a tax period commencing on or after 1st of June 2023, and such threshold shall only continue to apply to subsequent tax periods that end before or on 31st of December 2026. The revenue, on the other hand, should be noted that the UAE does not have its since the UAE does not have its own generally accepted accounting principle. Usually, the IFRS are the commonly used business standard in preparation of book of accounts. So for the determination of revenue, applicable accounting standards accepted in the state must be applied. Aside from those three conditions, there are other additional condition that has to be met in order for a person to elect itself to apply for the small business relief. So a resident person must not be a constituent company of an M&E group as defined in Cabinet Decision number 44 of 2020. So these are group of companies with operations in more than one country that have consolidated revenue of 3.15 billion AED. Further to that, a qualifying free zone person will also be not qualified to elect itself for a small business relief. Please let us know if the voice is audible or if there's any problem with it. So, upon availing the small business relief, there are certain limitations, as in reference to like carry forward of tax losses and net interest expenditure. So, where an election to apply the small business relief is made in a tax period, any tax losses and net interest expenditure incurred in such tax period cannot be carried forward to any subsequent tax period. So similarly, any unutilized tax losses incurred in previous tax period where an election to apply for the small business relief was not made may be carried forward to the subsequent tax period in which an election to apply in the small business relief is not made. But then it's going to be subject to certain conditions of Article 37 of the Corporate Tax Law, wherein they have mentioned that the amount of tax losses used to reduce the taxable income for any subsequent tax period cannot exceed 75% for that tax. Further, a taxable person cannot claim tax loss relief for losses incurred before the date of commencement of corporate tax, losses incurred before a person becomes a taxable person, and losses incurred from an asset or activity the income of which is already exempt or otherwise not taken into account under this decree. So, similarly to that, any net interest expenditure incurred in previous tax period where an election to apply for small business relief was not made may be carried forward to the subsequent tax period in which an election to apply for the small business relief is not made. And again, it's going to be subject to the conditions of Article 30 of the Corporate Tax. The ministerial decision have also specifically highlighted the artificial separation of business. So artificial separation or disaggregation are a practice where some businesses may separate the different elements of their company to multiple separate legal entities, wherein in reality they are just one company and the main purpose of separating them is to avoid corporate tax obligation or taxes obligation. So for the purpose of determining whether the business or business activity has been artificially separated, the authority shall consider whether the arrangement was undertaken for a valid commercial purpose and whether the person carry on substantially the same business or business activity by taking into account all relevant facts and circumstances, including but not limited to their financial, economic, and organizational life. Where the authority establishes that one or more persons have artificially separated their business or business activity and the amount of revenue across the person's entire business or business activity exceeds the threshold, which is 3 million dirhams, and such one or more persons have elected to apply the small business relief, this would be considered an arrangement to obtain a corporate tax advantage under Clause 1 of Article 50 of the Corporate Tax Law. So under corporate tax, there are certain types of income and expenditure that shall not be taken into account in the determination of the taxable income, given that it meets the condition as listed on the law. So these exemptions are given to prevent the income from being subject to economical or juridical double taxation. So as presented, there are five lists of exempted incomes under the corporate tax law, which is the dividend and other profit distribution received from a juridical person that is a resident person, exempt without any conditions or requirements. The next one is dividends and other profit distribution received from a participating interest in a foreign juridical person, subject to certain conditions that would be specified on the law. The third one is any other income from a participating interest as specified on the Article 23 of Corporate Tax Law, which wherein we will also be discussing it later on upcoming slides. The fourth one is income of a foreign permanent establishment that meets the condition and following an election as well. And lastly, income derived by a non-resident person from operating aircraft or ships in international transportation that meets the certain conditions. So this specific exemption is given to ensure that the corporate tax law aligns with the international standards for the taxation of international transportation by recognizing the reciprocity principle. So the first one that we will be discussing under the exempt income is the participation exemption. So participating interest is defined as a significant long-term ownership interest in a juridical person, which is referred to as the participation that suggests some degree of control or influence over the participation. So an example of income coming under these are dividends and capital gains. So in addition to the participation exemption being a net income exemption, the participation exemption is a symmetrical exemption of income from participation interest. That is, a qualifying capital revaluation and foreign exchange gains are exempt from corporate tax, and equally, no deduction for corporate tax is allowed for capital losses, foreign exchange losses, or impairment losses, except of certain losses realized on the liquidation of a participation. So under this, no election and application is necessary, provided that all the cumulative conditions as what is presented on the screen, under which an ownership interest in a participation will be considered a participating interest are met. So in the first condition, the participating interest represent a 5% or greater ownership interest in the participation. So this indicates that the participation must have a capital divided into shares, membership interest, or other securities or rights that entitle the holder to profits and liquidation proceeds of the entity. The second condition is the participating interest must be held or intended to be held for an interrupted period of at least 12 months. Income received from a participating interest before the minimum holding period or is completed can benefit from the participation exemption as long as the taxable person has the intention to hold the participating interest for at least 12 months. The participation must be subject to corporate tax or equivalent of 9% or more. This condition requires the participation to be subject to corporate tax or any other tax imposed under the applicable legislation of the country or territory in which the juridical person is resident, which is of a similar character of corporate tax. So the ownership interest in the participation entitles the holder to at least 5% of the profits and liquidation proceeds. So the ownership interest that is being referred to refers to the legal and beneficial ownership of the shares or other ownership in the participation. So the fifth condition that they have specified is the 50% or less of the assets of the participation consists of non-qualifying interest. So failure to meet this condition will deem the participation as a passive or portfolio investment that does not qualify the participation exemption. So aside from that, the participating interest must meet any other conditions as may be prescribed by the minister. Under the participation exemption, the following income shall not be taken into account in determining the taxable income. So dividends and other profits distribution received from a foreign participation that is not a resident. So the dividends include like stock dividends, bonus shares, dividends in kind, and other forms of actual or constructive profit distribution. Gains or losses on the transfer, sale, or other disposition of participating interest or any part thereof, taking into account the 12-month period stipulated or the 2-year period, will not be taken into account as well in determining the taxable income. So, aside from that, foreign exchange gains or losses in relation to participating interest and impairment gains or losses in relation to participating interest will also not be taken into account in determining the taxable income. So, this exemption, as I have discussed, will not be applicable or will possibly not be applicable on some certain circumstances, such as when the participation can claim a deduction for the dividend or other obligations, other distributions made to the taxable person under the applicable tax legislation, or on the circumstances if a taxable person has recognized a deductible impairment loss in respect of the participating interest prior to the participating interest meeting the conditions. Or lastly, if the taxable person or its related party who is subject to corporate tax has recognized a deductible impairment loss in respect of a loan receivable from its participation. So under these three circumstances that I have mentioned, the exemptions that I have discussed a while back will not be applicable. The next income that is exempted from corporate tax that was specified on the law is the foreign permanent establishment exemption. A foreign permanent establishment can be defined as a fixed place or other presence or activities of a resident person in a foreign jurisdiction, which could constitute a permanent establishment. So, as I have previously discussed as well on the previous webinar that we have had, both income from within and outside of the UAE falls within the scope of corporate tax. However, this exemption allows a resident person to make an election to not take into account the income and associated expenditure of its foreign permanent establishment in determining its taxable income. So once an election is made, both the income and associated expenditure, which refer to the income and associated expenditure of all the qualifying foreign permanent establishment of the resident person on the relevant tax period will not be taken into account in the determination of the taxable income. So, in determining the income and associated expenditure of a foreign permanent establishment, a resident person and each of its foreign permanent establishments shall be treated as separate and independent person. So, again, on these specific terms, the arm's length principle are to be applied upon dealing or transacting with the resident person and its foreign permanent establishment. Such transactions include, like for example, transfer of assets or transfer of liability. Aside from that, a limitation upon election is also there. Like for example, the foreign tax credit that would have been available once you have made an exemption for foreign permanent establishment exemption cannot be availed anymore. And an election for this exemption means that both the profit and losses of the foreign permanent establishment will not be taken into account. The last exempt income that was specified on the law is the non-resident person operating aircraft or ships in international transportation. So this exemption is granted under the reciprocity principle, wherein UAE residents operating an aircraft or ships in a foreign jurisdiction will similarly be exempted or would have the same tax treatment as applied. So for this specific exemption, certain conditions has to be met. So it is that the activities that falls within this exemption includes like international transport of passengers, livestock, mail, parcel, merchandise, or goods by air or by sea. It also includes like the leasing or chartering aircraft or ships used in international transportation, as well as the leasing of equipment which is integral to the seaworthiness of ships or the airworthiness of aircraft used in an international transportation. Aside from this, the exemption applies only if the UAE resident on a foreign jurisdiction will have an equivalent exemption or exclusion from a tax that is similar in character to corporate tax by the country in which the non-resident person resides. Again, this refers to the reciprocity principle that I have mentioned a while back. For the last part, we will be discussing about the qualifying income. So, as previously discussed on the webinar sessions that we have had, the qualifying free zone person will be subject to two tax rate. So that's going to be the 0% on their qualifying income and 9% on income that does not meet the conditions for the qualifying income. So based on the ministerial decision that was released this yesterday, qualifying income has three categories that they have specified. So on the first category, they have mentioned that these are the income derived from the transaction with other free zone persons, except for income derived from excluded activity. So the key factor to identify whether a transaction is with a free zone person is if the beneficial recipient of the goods or services rendered is a free zone person. The beneficial recipient that I have mentioned refers to the person who has the perks to consume or enjoy the goods or services and doesn't have the legal obligation to pass it on onto another person. So the next category is the income derived from transaction with a non-free zone person, but only in respect of qualifying activities that are not excluded activities. And lastly, any other income provided that the qualifying free zone person satisfied the de minimis requirements as prescribed by the minister and cabinet. So the de minimis requirement shall be considered satisfied where the non-qualifying revenue derived by the qualifying free zone person in a tax period does not exceed a percentage of 5% of the total revenue of the qualifying free zone person in that tax period as specified by the minister, or an amount as specified by the minister, which is 5 million dirham. So whichever is lower would be applied to it. Non-qualifying revenue that I have mentioned refers to the excluded activities and the activities that are not qualifying activities where the other person is in the transaction is a non-resident person. So on the determination of the non-qualifying revenue and total revenue, the revenue and immovable property within free zone, such as the transaction with non-free zone person on commercial property and transaction with any person on non-commercial property will not be considered, as well as revenue attributable to domestic permanent establishment or foreign permanent establishment of the qualifying free zone person would also not be considered on determining the total revenue of the qualifying free zone person. So the non-qualifying income or the taxable income of a qualifying free zone person that would be subject to corporate tax rate of 9% are those income attributable to a domestic permanent establishment or a foreign permanent establishment, as well as the income attributable to the immovable property located in a free zone. So for the detailed discussion of the qualifying income and qualifying free zone person, we would be having it on the upcoming webinar sessions that we would be having.